Yo guys, welcome back to Stock Talk Insider. Today I will be talking about e.l.f. Beauty. e.l.f. Beauty is another stock that reported its earnings yesterday. Yes, it went down a lot, so I want to talk about what brought it down and, well, how we go further, what to expect, what was the guidance of the company and its team and the CEO, and just a couple of macroeconomics also going into it. And yes, of course, today the market is ripping us apart, but with these days, you know that you can buy a lot because red days like 8% down on the portfolio and you believe in the companies, well, just buy. You know, if you like your companies that you own, you are a long-term investor, you see days like this with 8% down on the whole portfolio, with like a couple of positions down already 8%, 33%, 22%. Well, things like that will buy. So I already put in $1,000 already today, so around $1,000. I bought 10 more e.l.f. stock shares, and I bought 2 more of AMD because I just believe too much in AMD. I actually should stop buying AMD because I already have 181. But going further, I believe that e.l.f. is still a very good buy. So going straight into everything that we have to talk about for e.l.f. As you see, the stock has plummeted a lot. And, well, why that is, we'll talk about right now. So we're breaking down the latest earnings of e.l.f. So these are the earnings. So I put them all in a word. So it's, it's very good so it's easy to look at. And so everyone has a clear picture of it. So the last earnings from e.l.f. Beauty are one of the strongest growth brands in the US beauty industry over the past 5 years, and a stock that has massively rewarded long-term shareholders, of course, with a lot of peaks and a lot of bottoms, but you can say that it's way higher than it was 5 years ago. So the most recent 2 quarters have shifted that narrative, pretty drastically, especially now with this quarter, not because the brand is weakening, but because the business is now transitioning into a new scaling phase. Let's go through the numbers, the implications, and what matters going forward. So a quick positioning overview. So e.l.f. sells vegan, cruelty-free, clean beauty with prestige level products performance at drugstore pricing. So very cheap actually. This price to quality advantage is one of the strongest competitive moats in the entire beauty sector. It works online, it works in Ulta, Walmart, and Target. So, the retailers. It works globally, and it's especially powerful when consumer budgets tighten. When consumer sentiment weakens, people don't stop buying makeup. Maybe they start buying it more smarter in a way. So they simply trade down from $40 prestige to $8 in e.l.f. Meaning e.l.f. doesn't just survive slower economic cycles, it usually gains market share in them. So for quarter 3 full year 26, quarter ended September 30, 25, the results were the following. So we had net sales of 343 million, which was up 14%, but not what was expected. Then we had gross profit of 238 million, which was up 12%. Then we had operating income, which was down significantly, 7.7 million. That was reported, so that was a result. We had a GAAP net income of 3 million, sharply down. Adjusted EPS of 68, which was down from 77 cents, and an adjusted EBITDA of 66.2 million. I do want to mention that EPS in its whole did beat the expectations of the analysts, and that was a beat, but the loss was on the revenue side, so revenue was not a beat. Then the that's for soon. Going forward, the real story is that top line demand is still strong, but marketing spending increased, integration and supply chain costs stepped up, debt servicing costs increased, and SG&A grew faster than revenue. This is a cost normalization phase, not a demand slowdown. So going forward with the fiscal 26 guidance, what the company is telling us on all of this news, the metric or revenue, the adjusted EBITDA, and the adjusted EPS. So the full year 25 guidance was 1.3 billion, which is now an outlook for full year 26 of 1.5 billion. I do want to mention that this is not really impressive to see or not really exciting to see, but as you know, the team is a very good and very strong team. They don't like to underperform in reporting their earnings, so of course it's very logical to have very, very sleek type of numbers that are now being presented. And going forward, the strong growth does continue, but not as expected. So that's also in the guidance a miss. So we had a miss in the revenue, we had a miss in operating income, GAAP income, the adjusted EBITDA slightly. Adjusted EPS was actually up, but still down 77 cents. Then for the guidance, we also had not the best guidance. It was guidance going higher, but not really guidance beating expectations. Then adjusted EBITDA of 297 million full year 25, and the full year 26 outlook is now 302 to 306 million. So margins stabilizing, not expanding yet. That's very important to know that they are not expanding yet. The adjusted EPS is $3.39 for the full year 25 and has now been put to $2.80 and $2.85 for the full year 26. EPS temporarily down due to tax, SG&A, and share count and debt, and of course a little bit about tariffs news. Then going forward about tariffs, so tariffs, cost inflation, and macro environment, there has been renewed concern around import tariffs, freight pricing, and component costs. So e.l.f. sources a meaningful amount of product from China and Asia-based manufacturing ecosystems. If tariffs increase, input cost pressure rises, but here's the key: e.l.f.'s margin structure is already high and they have pricing power because their price positioning is already the lowest premium. Even if they increase retail price by 50 cents to $1, demand does not fall. Meanwhile, consumer sentiment in beauty remains strong. Beauty historically outperforms in recessions. Beauty is linked to emotional well-being and identity. People will cut electronics, designer wear, vacations before they cut makeup, because makeup has to do with your own identity, as I said before. And a new phone, well, sometimes you can wait with a new phone. That's not your identity. So, just to have it in a little sentence, we will always have mascara, foundation, and brow pencils. So e.l.f. wins especially when customers trade down from $40 to $8 price points, which is priceless, precisely where the economy is right now, or at least going to for this type of moment. The two red quarters, also something to mention, is competitive fire. This part is crucial in my opinion. For over 20 quarters, more than 5 years, e.l.f. consistently beat expectations. Now 2 quarters have come in softer than expected, of course, and this leadership team, this is the thing that I mentioned before, it's a very good team that doesn't want to miss. Especially CEO Tarang Amin is known for being hyper competitive with zero tolerance for loss of momentum. They are not shrugging this off, they are not complacent, they are not defensive. They are tightening spending, accelerating high margin skincare, re-optimizing channel mix, and refocusing on efficiency. This reset pressures before next expansion wave. Also, we do have to talk about the Rhode acquisition, but that's something for later in the video. Going forward, the demand as an investment view is strong, brand equity is strengthening, consumer loyalty is rising, pricing mode best in category actually, the skincare runway just beginning, international scaling not even talked about yet, but that is still in an early phase and is also a catalyst for coming and later years that can be bigger than now. The path to growth, not the existence of growth, is the only thing changing now. So yeah, near-term stock behavior is more volatility, more valuation sensitivity, slower EPS growth while scaling costs normalize, and the long-term outcome, if execution continues, is that revenue compounds 20% annually, skincare increases margin profile, EPS reaccelerates once cost structure stabilizes. And actually looking at the stock, it's, in my opinion, for the quarters that have been reported, last 2 quarters, I can get into it that why it sold off this big. But if you look at the guidance and look at what e.l.f. Beauty can do in the coming years, I think that the sell-off is a little bit too much. And I think that in coming months, this sell-off will be bought back. So yeah. So now going forward and ending this video with the Rhode acquisition. So the key update around Rhode is that e.l.f. Beauty is now the owner of Rhode. Rhode is the acquisition for e.l.f. So for about $1 billion with roughly 212 million in trailing 12-month revenue, which will be joining the revenue of e.l.f. already. Coming from the Rhode brand, this is a strategic move to boost e.l.f. skincare mix, expand margins over time, and add more premium aspirational layer to the company's brand portfolio. This is very big for the future and for next year. Rhode has insane cultural demand, especially with Gen Z, but they didn't yet have the global supply chain, manufacturing scale, or a retail distribution to expand fast. e.l.f. does have all of that. So what this really means is that Rhode brings brand heat, e.l.f. brings scale, and together this should unlock faster revenue growth, bigger revenue growth, stronger margin expansions, and integration stabilizes. They already put in their guidance that they will expect 200 million of extra revenue because of Rhode. And yes, in the short term, profitability is tighter because of this. Yes, guidance still reflects investments and scaling costs, but long term, the setup is clear and very big and promising. e.l.f. is no longer just a fast-growing cosmetic brand. They're now building multi-brand beauty house with global potential. The acquisition strengthens their moat, deepens their pricing power, and positions e.l.f. for the next leg of growth, of course. Once margins normalize, this is a move that's meant to pay off over years, not quarters. So, ending this video, e.l.f. will recover very nicely, especially if you have some positive news coming out, and with next quarter if there is good guidance, and of course just a little bit more of revenue growth again, and that therefore it doesn't have to happen next quarter, but once a quarter hits when there is again some revenue growth as expected, of course, because it was a miss on expectations, and the margins improve extra, then we'll have a nice way up again. So for now, we do see that e.l.f. Beauty is down 34% today. I was once up 1,000 euros, now I'm down 1,000 euros, so that's like a difference of 2,000. This is also one of my more smaller positions, but as you see in my portfolio, I have AMD that is the biggest position. SoFi that's next under AMD as the second biggest position. And then I have a couple of positions, 3 to be exact, like e.l.f. Beauty, PayPal, and Shopify that are almost the same in size because, yeah, of course, there are some fluctuations. So the one is bigger than the other this day to that day. Then we have the smallest of Honest, so that's a very small one, probably going to make it a little bigger, but not too much because it's still a speculation stock, of course. And then, just having PayPal, Shopify, and e.l.f. Beauty as the more smaller positions under the big positions of AMD and SoFi. I will be adding more to e.l.f., PayPal, and Shopify over the coming years. And at a certain point, I will be selling the stocks at their valuation that I like to sell them. But in coming years, that's not really happening for now. Unless my view changes, I get another stock there that I'm more convinced in than like an e.l.f. Beauty or a PayPal or a Shopify or an Honest. And then I just sell and I buy the other stock. You don't have to be married with a stock. That's very important. So if you like a stock, you don't have to marry it. And if there's a better opportunity, you go for that, of course. If you are better in cash, you go in cash. That's how simply it is. I like to invest the most of my cash. And yeah, now as you see, once I was up 12k on the day, now we're down 6k on this day. So it's really nothing really big. We are focusing on the long term, and on the long term is really paying off for me, because we were at the peak we were at 44k, and I believe that that can be doubled in like 2 to 3 years or even more. And yeah, thanks for watching, and I'll see you guys later. Bye.